There is a company in Boston that traces its charter back to 1792. It has no branches you can walk into. It sells nothing you can buy. Most Americans have never said its name out loud. It holds more than $50 trillion. Not manages, holds, safeguards, settles, records. The retirement savings of teachers, firefighters, nurses, postal workers. That money does not sit in a vault. It sits inside the machinery of a company called State Street. And here is the part that does not fit. Today, State Street is a defendant. In a federal courtroom in East Texas, a coalition of Republican-led states alleges that State Street's investment arm, together with two rivals, used its shares in America's coal companies to squeeze production and push up the price of electricity. The states call it a cartel. State Street has called the case baseless and without merit. A judge has allowed it to move forward. Nothing has been proven. But strip the politics out of it, and a stranger fact is left standing underneath. Three companies, State Street, BlackRock, and Vanguard, sit among the largest shareholders of almost every major public company in the United States. The airline you fly, the bank that holds your paycheck, the company that makes your phone, your coffee, your gasoline. The same three names, over and over. Nobody voted for that. Nobody designed it. There was no takeover, no hostile raid, no secret meeting in a wood-paneled room. It happened because millions of ordinary people did the most boring, most responsible thing a person can do with money. This is the story of how a 234-year-old bank became the silent part owner of almost everything you touch, and how a courtroom in Texas is now forced to ask a question American law has never really answered. Who owns a company when everyone owns it? To understand what is happening in that Texas courtroom, you have to understand what State Street actually does. And almost nobody does, because it is deliberately, magnificently boring. State Street is a custodian. When a pension fund in Ohio buys $1 billion of Japanese stock, somebody has to hold that stock. Somebody has to prove it exists, settle the trade, convert the currency, count the dividends, and produce a record that a regulator will accept. That somebody is a custody bank. It is the plumbing underneath the plumbing. As of the spring of 2026, State Street held more than $54 trillion in assets under custody and administration. That is not a metaphor. That is a filed, audited number. It is larger than the annual economic output of the United States and China combined. But custody is only half the company. The other half is called State Street Investment Management, and it does not merely hold other people's stock. It owns stock on behalf of millions of people who have never heard of it. More than $5 trillion of it. And that is where the trouble starts. Because when you manage $5 trillion of index funds, you do not get to choose which companies you own. That is the entire point of an index fund. You own all of them. Every company in the index, in proportion, forever. You do not pick winners. You do not fire losers. You simply hold. It is the most passive act in all of finance. And it has produced the single greatest concentration of corporate ownership in the history of the modern world. Consider what that means in practice. State Street, BlackRock, and Vanguard are known in academic papers by a nickname that sounds like a rock band, the Big Three. Between them, they sit among the largest shareholders of the overwhelming majority of the companies in the Standard & Poor's 500, the index that is, for most purposes, the American economy. The bank that holds your mortgage, the airline that lost your luggage, the company that refines your gasoline, and the company that sells you the coffee you drink while you complain about the price of gasoline. Same three names, on the shareholder register again and again and again. Now ask the obvious question. If the same three institutions are among the biggest owners of every airline in America, do those airlines really compete against each other as hard as they would if they had different owners? Economists have been arguing about that question for years. In late 2024, a group of Republican attorneys general decided to stop arguing and sue.
Their theory was narrow, and it was aimed at coal. The states alleged that BlackRock, Vanguard, and State Street's asset management arm had joined climate coalitions, organizations with names like Climate Action 100+ and the Net Zero Asset Managers Initiative, and used their common shareholdings to pressure American coal producers into cutting output. Less coal, the states argued, means costlier electricity, and costlier electricity means every household in America paid for it. The states called it a cartel, not a metaphorical one, a literal antitrust conspiracy under federal law. The asset managers rejected all of it. State Street said the lawsuit was baseless and without merit, and that there was no collusion aimed at coal prices. Every one of them asked the court to throw the case out.
In August of 2025, a federal judge in the Eastern District of Texas refused. He did not say the states were right. He said the opposite of that in places. The judge acknowledged that the states had no direct evidence of any conspiracy, that their case was built on circumstance, and that they might well fail to prove it. He described the decision as a close one. But at this stage of a lawsuit, the court has to assume the accusations are true, and on that basis, the case was allowed to proceed. Then it escalated in a way almost nobody expected. The Department of Justice and the Federal Trade Commission filed a formal statement in support of the states, the first time the federal antitrust agencies had ever taken a position in court on what common ownership actually means under American law. And in February of 2026, one of the three defendants broke.
Vanguard settled $29.5 million paid to the states. No admission of wrongdoing, but a set of promises that it would step back, stay passive, and stay out of climate coalitions. BlackRock and State Street refused. They are still in the fight. Which brings us back to the beginning, to the question underneath the lawsuit, the question no courtroom has ever really answered. How did an 18th century Boston bank end up as a part owner of corporate America? The answer does not begin on Wall Street. It begins with a man who looked at a bank and refused to see a bank. The first clue is not a person, it is a machine. State Street began, like almost everything in early American finance, as an ordinary bank, a charter signed in Boston in 1792, a building on the street that gave the company its name. For most of 2 centuries, it did what banks do. It took deposits, it made loans, it survived wars and panics and depressions by being conservative to the point of dullness. If the story had stopped there, State Street would be a footnote, a regional New England bank, absorbed in some merger, its name sanded off a building. What changed everything was a crisis of paper. In the late 1960s, the American stock market did something it had never done before. Ordinary people started trading. Volume on the New York Stock Exchange doubled, and then doubled again. And Wall Street discovered it could not physically keep up. Because in 1968, a stock was still an object, a certificate, a piece of engraved paper that had to be found, signed, verified, hand-carried, and filed. Every trade generated paper, and every piece of paper had to be matched to another piece of paper by a human being in a basement. The basements drowned. Trades went unsettled for weeks. Certificates vanished. Brokerage firms could not say with confidence what they actually owned. The exchange took the extraordinary step of shutting down trading on Wednesdays, closing the busiest market on earth one day a week, simply so the back offices could catch up. Firms collapsed, not because they made bad bets, because they could not do the paperwork. This is the moment American finance splits in two. Wall Street saw an embarrassment, a clerical problem, something to be fixed and forgotten. A handful of people saw something else. They saw that the bottleneck of modern finance was not intelligence or capital or nerve. It was record-keeping. And whoever solved record-keeping at scale would end up holding the machinery that everyone else was forced to use. That is not a banking insight. That is an engineering insight. And in 1975, State Street handed its bank to an engineer. His name was William Edgerly. He had a degree from the Massachusetts Institute of Technology and a business degree from Harvard, and by the standards of the institution that hired him, a disqualifying flaw. He had never been a banker. Edgerly came out of the chemical industry. He thought in throughput, in process, in systems that scale. And when he looked at a 200-year-old bank, he did not see a bank. He saw a factory that had not yet realized it was a factory. What he did next was, by any normal standard, insane. He began dismantling the bank. He pulled back from retail branches. He stepped away from the ordinary lending business that had sustained the company since George Washington was alive. He took an institution whose entire identity was 2 centuries of careful banking and told it to stop being a bank. People inside the company reportedly thought he had lost his mind. In its place, Edgerly built something that had no obvious name yet. He hired technologists. He poured money into computing at a moment when computing was a cost center, not a strategy. He turned State Street into an industrial-scale processing operation whose product was not money. Its product was certainty. The certainty that when a pension fund in Michigan owned a share of a company in Frankfurt, the share existed, the record was clean, the dividend arrived, and a regulator could audit every step of it. And the timing was almost unfair. In 1974, Congress had passed the Employee Retirement Income Security Act, a sweeping law that dragged American corporate pensions into a new world of accounting, reporting, and fiduciary obligation. Overnight, every large employer in America needed someone to hold its retirement assets and prove it was doing so properly. State Street had spent the decade building precisely that. The company stopped competing for depositors and started competing for the invisible plumbing of institutional money, custody, settlement, fund accounting, the unglamorous work nobody wanted and everybody needed. By the end of the 1980s, the boring bank from Boston had quietly become one of the most profitable financial institutions in the country. But a factory is only as important as what runs through it. Edgerly had built an engine capable of processing enormous volumes of securities cheaply and accurately at a scale no rival could match. And then, in 1993, somebody invented the product that engine was built for. He was 74 years old. He was not a banker. He was a physicist. And what he built would eventually reorganize the ownership of corporate America.
His name was Nathan Most, and he had spent the war working on acoustics for the United States Navy. He was a physicist by training, a commodities man by accident, and by the late 1980s, he had landed in an unlikely place, new product development at the American Stock Exchange. He was in his 70s. He was surrounded by people half his age who had spent their entire lives inside markets, and he did not think like them at all. Most thought like someone who had spent years around warehouses full of physical goods, around commodities you could touch, around a very old idea, so old that traders had stopped noticing it: the receipt. Here is the idea in its entirety. You do not carry the gold. You carry a piece of paper that says the gold is in the warehouse. And once the paper exists, the paper itself can be bought and sold, split and traded, priced and argued over, while the gold never moves an inch. Most looked at the stock market and asked a question that, in hindsight, is obvious, and at the time was heresy. What if you put an entire index in the warehouse? Take all 500 companies in the Standard & Poor's 500, deposit them, issue receipts against them, then let those receipts trade on an exchange all day long like a single stock. One ticker, one price, one click. An ordinary person with an ordinary account
could buy the entire American economy in a single trade.
It sounds inevitable now. It was not. According to accounts of the period, most took the idea to the man who should have loved it most, the founder of Vanguard, the great evangelist of index investing himself, and was reportedly told no. The objection was that letting an index fund trade all day would simply invite people to trade it, and trading costs money, and cost is the enemy of the index investor. He was, arguably, right about that. He was also, arguably, describing the future. Most kept going anyway. It took years of grinding through the Securities and Exchange Commission, the federal regulator that has to approve anything genuinely new in American markets, before the thing was allowed to exist. On the 29th of January, 1993, it began trading on the American Stock Exchange. It was called the Standard & Poor's Depositary Receipt, ticker symbol SPY. In the industry, they called it the Spider. Somebody hung an inflatable spider from the ceiling.
And here is the part that matters for our story. A fund like that cannot exist on its own. Someone has to hold the 500 underlying stocks, someone has to verify the basket, process the creation and redemption of shares, and reconcile the whole thing every single day at industrial speed without error. Because if the receipts and the warehouse ever drift apart, the entire product is a fiction. That is not a Wall Street job. That is a factory job. State Street had spent nearly 20 years building the factory. The bank that walked away from banking became the operational backbone of the exchange-traded fund, the invention that would, over the next 30 years, quietly rewire who owns corporate America.
Because the ETF did something the mutual fund never quite managed. It made owning everything easier than owning something. Buying an index fund requires no research, no conviction, no opinion about whether one company is better run than another. It requires no courage. It is, by design, the abdication of choice. And it turned out to be the single most effective wealth-building decision available to an ordinary American over the following 3 decades. So they did it, tens of millions of them, through workplace retirement plans, through brokerage accounts, through automatic payroll deductions that nobody ever looked at again. Every paycheck, a little more money flowed into funds that were legally obligated to buy every large company in America. Not the good ones, all of them.
Nobody was trying to accumulate power. That is the crucial thing. There was no strategy, no ambition, no plan to sit at the head of the table. There was only a fee war. Index funds competing to charge less than each other until the cost of owning the entire American stock market rounded down to almost nothing. And in a business where the product is identical and the price approaches zero, only the largest survive. Scale ate everything. Which is how 3 firms, the 2 giants of the index business and the Boston bank that built the plumbing for it, ended up sitting on the shareholder registers of nearly every public company in the country. The money was passive. The ownership was not. And in 2026, State Street's asset management arm manages more than $5 trillion. The question the courts are now grappling with is what all that passive money is actually allowed to do with its vote. Because a share is not just a claim on profit. A share is a ballot.
A share is a ballot. That is not a metaphor. It is the law. Every share of common stock in an American corporation carries a vote on who sits on the board, on how executives are paid, on the resolutions that shareholders put forward each spring. For most of the 20th century, this power was scattered. Millions of individual investors held shares directly, and almost none of them voted. Ballots went in the trash. Boards ran the companies with almost nobody watching. Then the money moved into funds, and the votes moved with it. Here is the mechanism that almost nobody outside the industry understands. When you buy an index fund, you do not get the vote. The fund does.
Legally, the shares are held by the fund, and the fund's manager exercises the ballot on behalf of everyone in it. That is standard. That is how it has always worked. At small scale, it is harmless housekeeping. At $5 trillion, it is something else entirely. Because the manager is now casting votes at thousands of companies, every year in every industry, simultaneously. The same institution votes on the board of an oil company and a solar company, on a coal producer and a utility that burns the coal, on two airlines that are supposed to be tearing each other apart on the same route. Nobody designed this. It is simply what happens when tens of millions of people put money into the same product for 30 years.
And the asset managers were not passive about it. They could not be. Once you own a piece of everything and you can never sell, because selling would mean abandoning the index, you have exactly one tool left. You have your voice. So the giants built stewardship teams. They published voting guidelines. They wrote letters to boards. They met privately with chief executives. And through the 2010s, they increasingly used that voice on a subject that was becoming impossible to ignore: climate risk. The logic, as the asset managers described it, was fiduciary rather than political. If you own the entire economy forever, you cannot diversify away from a systemic risk. You are exposed to all of it. A fire in one part of the portfolio burns the portfolio. So they joined coalitions, names like Climate Action 100+, the Net Zero Asset Managers Initiative, groups that coordinated engagement with the world's largest emitters and asked them to disclose, to plan, to reduce. To the managers, this was risk management. To the states that eventually sued them, it was something with a different name. Look at the same behavior from the other side of the table. 3 institutions sit among the largest shareholders of the major American coal producers. Those 3 institutions join the same organizations, they make broadly aligned public commitments, and then, the states allege, they engage those coal companies with a shared expectation that output should come down. Coal producers are competitors. They are supposed to fight each other for market share. That is what competition means. But if the same handful of owners sits behind all of them, and those owners lean in the same direction at the same time, the states argued, the companies are no longer competing at all. They are being coordinated, not by a cartel of coal executives, but by the people who own them. And when supply falls, prices rise, and the electricity bill lands on a kitchen table in Texas. That is the theory. It has not been proven. The asset managers deny every part of it. State Street has said flatly that there was no collusion aimed at coal prices and that the case is without merit. But you can see now why a court was unwilling to throw it out. This is the genuine intellectual trap at the center of the case, and it is worth sitting inside it for a moment, because both sides are describing the same facts. If the big 3 do nothing, if they never vote, never engage, never speak, then trillions of dollars of American ownership become silent, and corporate boards answer to nobody at all. If the big 3 do something, if they use the votes they are legally required to cast, then the same institution is influencing every competitor in an industry at once, and American antitrust law starts twitching. There is no obvious third door. Passivity was supposed to be the safe choice. It turned out to be a position of enormous power that nobody had asked for and nobody knew how to hold. The Department of Justice and the Federal Trade Commission clearly understood the stakes. In May of 2025, they took the extraordinary step of filing a statement in the Texas case, the first time the federal antitrust agencies had ever formally told a court what they believed common ownership means. The big 3 were no longer just facing a group of state attorneys general. They were facing the antitrust apparatus of the United States government. And 9 months later, one of them decided it did not want to find out how this ends. Vanguard admitted no wrongdoing. It conceded no illegality, but it accepted a set of commitments that the Texas Attorney General described as first of its kind, a promise, in effect,
to be smaller than it is. It agreed to stay out of groups organized around climate-focused investment or stewardship objectives. It agreed to expand the ability of the people whose money it manages to direct their own votes. And it accepted what the settlement called passivity commitments, an undertaking not to direct or attempt to direct the behavior of the companies it holds. Read that again. The largest index manager in the world agreed to stop telling the companies it owns what to do. Vanguard admitted no wrongdoing. It conceded no illegality, but it accepted a set of commitments that the Texas Attorney General described as first of its kind, a promise, in effect, to be smaller than it is. It agreed to stay out of groups organized around climate-focused investment or stewardship objectives. It agreed to expand the ability of the people whose money it manages to direct their own votes. And it accepted what the settlement called passivity commitments, an undertaking not to direct or attempt to direct the behavior of the companies it holds. Read that again. The largest index manager in the world agreed to stop telling the companies it owns what to do. That is the answer this story has been building toward, and it is not the answer anyone expected. The Texas lawsuit was framed as a fight about coal. It was reported as a fight about politics. But what it actually produced, the first concrete outcome, the thing that is now written into a legal document, is a redefinition of what an owner is allowed to be. For a century, the great fear of American corporate governance was the absent shareholder, the apathetic owner, the investor who never showed up, never voted, and left executives to run public companies as private kingdoms. The remedy was engagement. Wake the owners up, make them vote. And now, the remedy has become the accusation. BlackRock and State Street did not settle. They are still in the case, and they still say it is baseless and without merit. That fight continues, and it may run for years, and it may end with them fully vindicated. Nothing about the coal allegations has been proven in court. But the settlement changed the weather regardless. Because once one of the three has agreed to a definition of passivity, that definition exists. It becomes the benchmark. It becomes the thing regulators point to, plaintiffs demand, and boards quietly expect. The industry has been handed a template for what a giant is permitted to say to the companies it owns. And the answer, increasingly, is less. So consider where that leaves State Street. It is one of the systemically important financial institutions on Earth. It holds more than $54 trillion in custody, more than the combined annual output of the two largest economies on the planet. If it stopped functioning tomorrow, trades would fail to settle, funds would be unable to price, pensions would be unable to pay. It manages more than $5 trillion in its own right. Its ownership stakes stretch across nearly the whole of corporate America. And it is being told, through litigation, through settlement, through political pressure, that the safest thing it can do with that ownership is to use it as little as possible. Which raises the question that nobody in this story wants to be the one to answer. If the three largest owners of corporate America all go quiet, if they vote mechanically, engage minimally, and take no position on anything that could be construed as coordination, then who is actually watching the companies? Not the individual investor. She owns her shares through a fund, and the fund holds the ballot, and she has almost certainly never asked how it was cast. Not the boards. Boards are the thing being watched. Ownership without a voice is not ownership. It is storage. And storage, in the end, is what State Street was always built to do. That is the strange symmetry at the heart of this company. Edgerly's great insight 50 years ago was that the most valuable position in finance is not to make the bets. It is to be the machinery that everyone else's bets must pass through. To hold, to record, to settle. To be indispensable and invisible at the same time. The company got exactly what it was built for. $54 trillion held for other people. $5 trillion more owned on behalf of people who will never send an instruction, a part ownership stake in almost everything you buy, drive, fly, eat, and borrow. And increasingly, a legal environment that says the correct thing to do with all that power is nothing at all. The most powerful shareholder in America may be the one that is now legally safest when it stays silent. Which leaves one last question. If nobody is really steering, who is?
If nobody is really steering, who is? The honest answer is uncomfortable. Nobody has to be. A public company does not require a captain. It requires only that no one with enough shares objects. And in an economy where the biggest owners are index funds that cannot sell, that are increasingly discouraged from speaking, and that face a lawsuit if they coordinate, the loudest voice at the shareholder meeting belongs to whoever bothers to show up. Sometimes that is an activist hedge fund with a 2% stake and a very sharp plan. Sometimes it is nobody at all.
That is the thing about this story that has stayed with me while making it. And it is the reason I picked this case for this channel, rather than another collapse, another fraud, another billionaire in handcuffs. There is no villain here. State Street did not scheme its way to $54 trillion. It got there by being the most reliable clerk in the room for 234 years. Nathan Most did not want power. He wanted a cheaper way to buy an index. And the tens of millions of Americans whose money built the big three were not conspiring. They were doing the responsible thing. They were saving. The concentration of ownership in the United States was not built by greed. It was built by prudence, compounded.
And if this is the kind of story you want more of, the machinery underneath the headlines, the empires that grew without anybody choosing them, subscribe. That is genuinely the whole ask. It costs you nothing, and it decides whether this channel gets to keep making them. And tell me in the comments which side of the Texas case you find more persuasive, because I have gone back and forth on it more than once. Now, back to the part of the story that has not resolved yet.
Because there is a version of the ending where the states are right. If the case goes to trial and the evidence shows what the attorneys general say it shows, that the largest owners of American coal producers coordinated, formally or informally, to reduce output, then American antitrust law is about to be pointed at the single most popular financial product of the last 30 years. And every institution holding trillions in index funds is going to have to explain what its stewardship team has been saying in private meetings. That has not been proven. It may never be. The judge himself noted that the states have no direct evidence of a conspiracy and that they may ultimately be unable to prove their claim. But the discovery process does not care what is likely. It only cares what is in the emails.
And there is a version where the stakes are wrong, and it is not a happy ending either. Because if the outcome is simply that the largest shareholders in America are frightened into silence, that every stewardship team decides the safest email is the one you never send, then the American economy ends up with the worst of both worlds. Ownership more concentrated than at any point in modern history, and accountability weaker than it has been in decades. Trillions of dollars, all pointed at the same companies, all legally required to hold, all too nervous to speak. That is what is actually on trial in East Texas. Not coal, not politics. The question of whether it is possible in the 21st century to own the entire American economy responsibly. Whether owner means anything at all when the owner is an algorithm executing a mandate on behalf of a retirement account belonging to a nurse in Ohio who has never once in her life thought about how her shares get voted. She owns a piece of nearly every company in America. She has never cast a single ballot. And underneath all of it, indifferent to the argument, the machine keeps running. Every night, in data centers in Massachusetts and Ireland and India, the plumbing State Street built settles the trades, reconciles the books,
converts the currencies, and proves that the money is where it is supposed to be. $54 trillion moved and counted and recorded by an institution whose founders signed their charter with a quill. It has survived a revolution's aftermath, a civil war, a Great Depression, a global financial crisis, a $500 million reckoning over how it treated its own clients, and a former executive who went to federal prison. It will almost certainly survive this too. The question was never whether State Street endures. The question is what it becomes on the way there.
Before we close, the two facts I left on the table. For roughly a decade, State Street was overcharging some of its own custody clients on foreign currency trades. When a pension fund holds foreign stocks, it needs foreign currency, and many clients let the bank handle those conversions automatically. State Street applied markups the clients could not see. In 2016, it agreed to pay hundreds of millions of dollars to regulators, to the Department of Justice, and back to the clients themselves to resolve the matter. The clients were retirement funds. The money belonged to teachers and public employees.
And separately, a senior executive in another division was convicted in federal court over a scheme to add hidden commissions to trades executed for institutional clients, among them a pension plan for postal workers. He was sentenced to prison. One man out of all of it.
I bring those cases up not to convict the company twice. It paid, it settled, it moved on, as institutions do. I bring them up because of the shape they share with everything else in this story. Every one of these episodes is the same act, performed at different scales. A tiny number applied to an enormous base. A basis point here, a markup there. A vote cast quietly on your behalf in a meeting you did not know was happening, at a company you did not know you owned. Individually, invisible. Multiplied by 54 trillion, decisive.
That is the real subject of this film. Not a bank, not a lawsuit. Scale. Alexander Hamilton and Thomas Jefferson had this argument in the 1790s, and it was never actually settled. Hamilton wanted concentrated financial power because concentrated power is efficient, and a young country needed efficiency. Jefferson was afraid of it because he believed that any power large enough to be useful is eventually large enough to be unaccountable. 230 years later, an American court is being asked to referee the same dispute. Except this time, nobody built the thing on purpose.
There was no conspiracy. There was a physicist with a good idea about warehouse receipts, an engineer who looked at a bank and saw a factory, a fee war that drove the cost of owning America to almost nothing, and 100 million people who did exactly what they were told to do. Save steadily, diversify, don't try to be clever, buy the whole market and stop looking at it. They followed the best financial advice of the 20th century, and in doing so, without a single meeting, they handed the ownership of the American economy to 3 institutions in Boston, Malvern, and Manhattan, and then went back to work.
The old fear was that a small number of men in a room would come to own everything. That is not what happened. What happened is that everyone came to own everything through 3 intermediaries, none of whom particularly wanted the responsibility, and none of whom can now put it down. State Street is 234 years old. It has outlived the country's first central bank, its bloodiest war, and every rival that ever tried to take it. It will very likely outlive this lawsuit too. The money is safe. That was always the promise. The money is counted, recorded, settled, and safe. Nobody ever promised anything about the power.
If this one landed, send it to the person you know who thinks nobody owns the stock market. And tell me which empire you want next.